The 2026 investing landscape, when it comes down to finance, is getting a lot harder. It's getting a lot more convoluted. It's getting a lot more driven by intimate policies, intimate lending scenarios. So I'm here with Jai once again, and let's unpack what you are seeing behind the lens of the 2026 lending regime.
Thanks for having me, Ollie. I think 2026 will be an interesting year. There's definitely a lot of talk around interest rates at the moment. Is it going to go up? Is it going to be on hold? And if we look at the most recent RBA announcement, it's a decision to hold.
Yep.
And mainly because inflation data has been trending up. So they're not confident to do a rate decrease at the moment. But at the same time, I don't also see that interest rates will go up much, even if they did. But there are definitely banks and economists pricing in fixed rates going up. So I think there's going to be a bit of uncertainty around interest rates. And as you know, with rates being uncertain, that also creates nervousness in the market, because consumers are typically very rate sensitive and very, very sensitive to the interest rate. Right. And I think that's also an impact if someone is holding more debt as borrowers. So that's going to create a little bit of uncertainty in the market, I believe. But still, there's going to be plenty of opportunity, because as we saw 2022 and 23, interest rates went up 13 times.
And people just kept buying, right?
Well, Queensland kept going up during that time. WA also had record growth. And now you've got Victoria. So I think 2026 will be an interesting year where you'll have markets shift. Some markets will go up, some markets may stay flat for a while. But yeah, I think interesting what happens with rates.
So that's on the topic of rates, from a more intimate level at what you do within investing lending. Obviously, the trust lending was a big back end of 2025 news, right? Affected how lending was then moving forward. What are you seeing in that trust lending space?
Yeah, again, very surprising news. I think for a lot of investors and borrowers. A couple of banks have announced some changes to trust lending. And look, I think it's mainly because of abuse of these policies. And Macquarie Bank is one of the big banks that were doing trust lending, and a lot of the lending had just basically stopped. So they basically came out and said, trust lending is no longer supported with Macquarie Bank going forward. And that will make a big impact in terms of investors who are looking to take advantage of that policy. But as we were discussing earlier offline, banks can change their policies overnight without much notice. So the key thing is you can't rely too much on one lender policy. So I think for investors, the key thing is if you want to grow your portfolio in 2026, you really need to strategize and look at your lender options and use a range of different banks to take advantage of different policies. Because if you're just going to use one bank and rely too much of your lending with one bank and one policy, you could just be told the next day this policy is no longer available, and then your lending is now stuck with them.
What's an example that you've seen, knowing how to assess one lender to the other to suit a particular client of yours?
Yeah, mainly around how banks assess their income, their expenses and liabilities. That all has a big impact on someone's lending capacity. And there are nuances across all of those things, right? Someone's income from Bank A and Bank B could be calculated a little bit differently. Right? So typically we want to look at that client's income level and how they're earning their income. So a good example is, like, for example, commission income. If someone's in a sales role, or if they're getting a bonus income, some banks will have a different calculation for that. Right? Some banks will take annualized of 3 months. Some banks will look at the average of 12 months. So if you have a really, really good quarter, you might be able to get a better result with a bank that lets you annualize that figure. Similarly, someone who's got a bonus income, they've just started a new job, their first year bonus might not be that strong, right? But if they've been with that company for quite a long time and they've got a sudden increase in bonus, we might be able to go to a bank that has a 1 year bonus policy, right? So then they don't take the average of the 2 years. So that is another example of how we can assess someone's income to go look at which bank policy will give them a better outcome.
Yep, that comes down to policies, being intimate in policies, and really what you do, right? And the crux of your day-to-day of really understanding what policy is going to suit, particularly when, you know, as you've outlined, salary, commission, bonus, overtime, allowances. I'm guessing that's all in the same basket of different policies, different banks will then suit right client to allow them to really maximize their borrowings off that.
Yeah, 100%.
What's the next hot topic that investors should be aware but cautious of?
Yeah, very good question and good timing.
Yep.
You probably would have saw the news as well about the APRA change to debt to income ratio. So as of 1st of February 2026, APRA is going to put a hard cap on debt to income ratio with the major banks, and that DTI is going to be 6.
Yep.
So typically how they measure someone's criteria to lend is usually going to be income, expenses, liabilities, but then there's also another metric called debt to income ratio.
Yep.
So at the moment, most major banks have a cap of around 7. So meaning if your income is 100,000 and you've got $700,000 worth of debt, you're pretty much at a hard cap, right? Because you're at the ceiling of that bank.
Which is technically one investment property or one PPR.
Correct. It's not that much. Right. In today's economy, that much is not really going to buy you more than 2 or 3 properties. That's going to make a very big impact for investors, because if you keep going back to the same bank, you're most likely going to hit that 6 debt to income ratio very quickly.
So how do we navigate this, knowing that this is a constraint? How do you navigate this to get the best outcome for investors?
Yeah, so that's a really good question. And this just goes to understanding how to navigate lending, right? As brokers, the good thing is we've got access to a very large panel of banks, whereas if you go direct to bank, you will only be able to get the policy of that bank, right? So you're at the kind of mercy of the bank's policy. So investors, it's a very different story, because when you're building a portfolio of properties, you want to use a range of different bank policies to suit your needs. It's like dating, right? You want to find the right match for you. No different to lending. You want to find the right bank that meets your needs, right? And your needs as investors are going to change very, very quickly, right? Because every time you buy a property, you're adding on debt. That debt then goes into your total debt. So you're going to hit these caps pretty quickly. Now, the APRA rules only apply to big banks, so major lenders, and they call them ADIs, which are authorized deposit taking institutions. Right?
So technically that means I can go in and walk into CBA, ANZ, Westpac, NAB, give them 10K, and they'll deposit that and pay you interest off the basis of 10K.
Correct, yeah. And the reason why it's so regulated is because they're holding other people's cash, right? So you can't have these banks take on too much risk, because if they do and they crash, then how are you going to get your money back?
It goes down to...
So that's why the Australian banking system is so strong, right? Unlike America, where, you know, GFC, things go all haywire. But then we've also got non-bank lenders, right? So non-bank lenders are non-ADIs, meaning they only lend money out. You don't deposit money with them. So it's actually more risk for the bank, right? Because they're the ones who are lending their cash out. Right, so a lot of people ask me, like, what's the risk? Like, is it riskier with the non-banks? I said, no, not really, because there's actually more of a risk for them. You're not depositing your money with them.
On that note, I'm going to ask you a question. Where do they get the cash to lend out?
Well, the interesting thing is that these non-bank lenders borrow money from the big institutions. Right? Because
it's sort of vicious cycle that comes back.
The big banks need to control their books, right, in a way that they manage risk, and they've got regulation. Whereas the non-bank lenders, they're mostly private institutions where they're borrowing money off the big banks and the large institutions. So they can create their own rules, right, and they don't have to follow APRA. Obviously, they still have responsible lending, right? So they still have serviceability calculators. They still have their policies, their credit policies in terms of what the customer or the borrower needs to meet, but they're a lot more relaxed. So most of the big banks have a 3% buffer that you're required to meet when you're borrowing money. So if your interest rate is 6%, they want to calculate that you can repay at 9%. The non-bank lenders usually only have a buffer of 1 or 2%. So that's why your borrowing power can be a huge variance.
So I think the biggest takeaway here for any investors or even any owner-occupiers listening to this is do not walk into a retail branch.
Or just assess your options, right? And if
As
you
a
get
starting-
told,
yeah.
if you get told that you're at a max limit,
Yep.
that may just be because of that bank, but you can still explore options with other banks.
And also reach out to the right broker to facilitate that landscape, because like we said, there's a lot of moving parts. Policies can basically shift over 24 hours. And if you're very much reliant on one lender, then one lender, one point of contact, it can become a very stressful time, particularly if you're in the middle of a purchase. And how do you navigate that?
When a bank changes the policy, it will be effective from a date going forward. So most of the time there will be notice, but usually it can be short notice. So if the pre-approval is done before that period, most of the time they will still honor it. So it should be okay. But again, it really depends on the bank, right? Some bank might say, look, this is just a hard stop. We're not honoring it anymore. So in that case, you're going to have to go find a different lender.
And that can be particularly stressful if you've purchased and you're going for unconditional approval of having 7 days, 14 days, whatever that pre-approval time frame is, to then go find another lender. But also resubmit all your documents to go through the process. And predictions of lending into what we are now, full steam ahead of 2026.
I think it will curb investor lending getting too risky, which is also a good thing, because you don't want people just taking out lending for the sake of taking out lending and doing silly things with money. So I think it will put a bit of a handbrake on a bit of risky lending. But from my perspective, I still think there's going to be a lot of investors out there in 2026 driving the market, because we fundamentally have a supply issue. Right, so I don't see the demand equation going anywhere. And so when the demand is still strong, you've still got a lot of people who need credit, right? So banks are also, they're institutions that need to make profit, right? They need to make money, right? So they need to find ways to also lend money out. So I think you'll see more and more lenders heat up competition, especially in the non-bank space, right? Because you've got APRA stepping in, changing the DTI rules. It means that a lot of the big banks can't do this type of lending, but then you've got a big range of non-bank lenders, and that panel is getting bigger and bigger, right? More competition. So I see that heating up a bit, right? So you might start to see some introduction of new policies. And so it means ultimately more choice for the borrower.
So you've gone from a borrower of 4 main big fours to now an array of 20, 30 plus.
Yeah, and I see that only becoming more common. There's going to be more people using non-bank lenders. Look, non-bank lenders might become a normal thing later on, because I think you probably agree, like in the last couple of years, most people don't know those non-bank lenders. They're like, who are they? Like, is it risky lending with them? I think going forward, people will start to see that as a normal thing. And almost like a second household name.
Yeah, and I think it definitely is, right? Like you look at the likes of, just to name a few non-bank lenders, the likes of Pepper Money, the likes of Liberty, the likes of First Mac, Resimac. They are pretty much out there, like, the interface of their web platforms, no different to, besides them not having a shop front. They very much user-friendly, easy to use in terms of their platform.
It's like telecommunications, right? Like back then you mainly just had Optus and Telstra, right? But now you're hearing a lot of people using like Audi Mobile, Dodo, TPG, there's a lot more of those out there as well. So it's no different to lending.
I think that's a very good comparison, a very good storyline that you bring it back to, because the likes of these smaller SIM cards then tap into Optus or Optus or Telstra's main network.
It's almost equivalent
as a server, but at a much lower cost.
Correct. Yeah.
At a much lower cost too.
Look, if you've got the borrowing capacity, if you've got the equity, and you've got the cash, you really shouldn't be waiting, because as we know in the past, interest rates are not a direct correlation of house prices.
So I think the biggest takeaway out of here on my part and on Jai's part is seek the relevant right advice, seek the relevant mortgage broker. And again, what we'll do is we'll link up your details down at the bottom. So have a chat to this guy. He will be able to matchmake the right lender policy, the right bank to suit your right profile, and really untap and allow you to move forward into 2026 and beyond. So there we have it, guys. Lending is a game that needs to be panned forward in a much more strategic manner as we travel into 2026.
Take the right bank.